Well, welcome everybody to the Lathrop GPM What You Need to Know About the CARES Act webinar. It's 12 o'clock and we're going to begin. This is Darren Macbeth speaking. I'm a government relations attorney with Lathrop GPM, normally working in our Minneapolis office, and I'm kicking off our webinar today on the CARES Act provisions for businesses. A few housekeeping items. These slides and the whole webinar will be recorded, and slides will be available and emailed out to you, and also available on our website sometime later today. And I also want to point out, we do have a chat function that is private between participants on the webinar, and only the co-panelists who are presenting today will see the chat or your questions. However, we're not able to answer every single one of those questions. You can try to bring things to our attention as we're rolling through the webinar, and we'll do our best to address some of those questions as we go, but it'll be more likely we would need to follow up, or you can follow up with us after the webinar, and our contact information will all be made available at the conclusion of the webinar on the last couple slides that we'll be going through. An overview of what we're going to cover today is here on the first slide. I'm going to cover broadly economic stabilization efforts from Congress and state legislatures due to the COVID-19 pandemic. My colleague Andrew Hoganson from our St. Louis office, normally from our St. Louis office, working from home like all of us are, is going to really drill down on two SBA loan programs that we're going to refer to as the EIDL and the PPP. I think that's of most interest to people today. Sarah Dunaway, my colleague from our Minneapolis office, is going to talk about the applicability of the EIDL and PPP loan programs to nonprofits, endowments, foundations, and healthcare providers. And Jeff Peterson, who normally works out of the St. Cloud office, is going to clean up and talk about working with SBA lenders and things to keep in mind in working with the lender on these programs. And he'll also remind everybody of contact information for those participating in the webinar today. And at the conclusion of Jeff's final slides, we'll have not really a round robin, but especially Andrew, who's going to get into the bulk of the SBA programs, will help bring things to a conclusion of anything that was left uncovered. Federally, we're in the third phase of what Congress has rolled out for economic stabilization due to the COVID-19 pandemic. Phase one happened in what now is a relatively small measure of $8.3 billion signed by the president on March 3rd, basically addressing and providing funding for healthcare providers and testing. What many are calling phase two, known as the Families First Coronavirus Response Act, was signed by the president on March 18th and provided $100 billion for extending unemployment benefits, providing employer tax credit, especially related to what is essentially mandated sick leave for employers under 500, and some food assistance measures. And what we're really going to talk about in some small part today, phase three, the CARES Act, is a $2.2 trillion, 843-page piece of legislation signed by the president last Tuesday on March 27th. And there are some talking about, especially out of the U.S. House of Representatives, the possibility of another economic stimulus known as phase four. We have a team monitoring that and getting ready for that, and stay tuned for more information if that happens. At a state level, there's also some things worth pointing out before we get into more of the federal measures. Starting with not an economic stabilization measure, but what many of you are experiencing of shelter-in-place executive orders from governors at the state level, getting into what's an essential business, what is critical infrastructure in terms of employees, supply chain partners, moving items deemed of critical infrastructure around commuting and on highways and on roads and on rail. And we have a team at Lathrop GPM that's been working around the clock, helping clients with those. And if you have questions in that area, please let us know later. Also at the state level, worth pointing out a couple Minnesota items here. First of all, an initial $50 million chunk for healthcare providers and hospitals has already been closed in terms of that application period. And then the second portion that you see on this screen, $150 million for assistance for healthcare providers. Guidelines and an application process we're anticipating to be made public from the Minnesota Department of Health next week. We have a team working on that. Secondly, the Minnesota Department of Employment and Economic Development were granted from the state legislature $30 million that essentially is for, in lieu of or piggybacking on the SBA lending opportunities that Andrew is going to get into here in a minute. And they're somewhat mutually exclusive for different reasons. If one is not eligible or available to get into the SBA-backed programs that Andrew is going to discuss, at least in Minnesota, and it's coming in other states, there are some lower level opportunities, in this case in Minnesota, up to a $35,000 loan with some forgiveness and 0% financing options. I'm not going to get into the Kansas measure, which was helpful to the hospitality industry because that $10 million that was appropriated has already been allocated and it's gone. In terms of the actual CARES Act, two provisions that Andrew is going to get into, here's just a snapshot without taking his thunder of what you're going to hear Andrew further explain. The EIDL, or Economic Injury Disaster Loans provision, was funded with $10 billion from Congress. It's generally available for employee businesses under 500 employees and provides loans up to $2 million. The forgiveness portion is not really a part of those EIDL loans. And as you can see with its appropriation of $10 billion, in contrast to the PPP, or the Paycheck Protection Program, that was appropriated $349 billion, there's obviously anticipation from Congress that these will be more valuable and more used. The PPP also is targeted at small businesses under SBA guidelines under 500 employees. There are some affiliation issues, some waivers for franchisors and others that Andrew will discuss. The heart of the PPP is the loan forgiveness potential of those loans, and the maximum of the loan will be the lesser of 2.5 times one's average monthly payroll, or 10 million. And for full loan forgiveness, one must maintain or reemploy certain wage levels and certain employee numbers. And as guidelines are rolling out as recently as yesterday, there's some other strings attached, including an apportionment of what one spends that money on during an 8-week period, where we're learning it's going to be heavy toward wages, like 75%, and 25% on other, which is basically rent, utilities, and qualified interest, which Andrew will discuss all these things. Before I turn it over to Andrew, other measures in the CARES Act that are worth pointing out. We're not here to talk about all the options for individuals and employees today, but I've highlighted a few of them for you, including the expanded unemployment eligibility, the additional $600 per week from the federal government for unemployment through the end of July, the measures known as cash infusion with $1,200 per single tax filer, or $2,400 married, plus $500 per child. That's phased out starts phasing out at 150,000, and those couples above 198,000 are not eligible for this, and those payments will be made automatically from the IRS and Department of Treasury based on 2019 and 2018 tax returns. There's also a measure worth highlighting that is a waiver on the qualified retirement account, 10% early withdrawal penalty. Tax provisions to help businesses are also contained as part of the $2.2 trillion CARES Act, including employee payroll retention tax credit. That is available only for those who do not use the PPP that Andrew will get into. There's also an employer deferment of the 6.2% Social Security tax. And there's an expansion of a company's use of net operating losses and taxable income limits. There are some other smaller but potentially still relevant SBA provisions. Andrew's going to highlight the two, what we feel are the best opportunities. But there are some other measures that you can follow up with us on or look for yourself on the SBA website, offering 6 months forgiveness of current SBA loans, including principal and interest. And some forgiveness is also available for borrowers who take certain new SBA loans in the next 6 months outside of the EIDL and the PPP. In the healthcare arena, there's $100 billion in the CARES Act for hospitals and institutional providers, including nonprofits, for unreimbursed healthcare-related expenses or lost revenues that are attributable to coronavirus. We have a healthcare nonprofit team at Lathrop GPM working on that for several healthcare providers. And finally, there's a small measure, relatively small, of $9.5 billion for agricultural producers of all shapes and sizes that really is under the discussion of the Secretary of Agriculture to determine how that will be made available. And one to keep your eye on, which we're doing at Lathrop GPM, is a $500 billion component of the CARES Act deemed economic stabilization for severely distressed sectors, 29 billion of which is for passenger airlines and cargo airlines. And another 471 billion will be for so-called large employers, 500 and up, that the Federal Reserve Bank will be deploying and coming up with guidelines, we hope soon. I'd now like to hand it off to Andrew.
Thanks everybody for attending. Thank you, Darren. As Darren indicated, I'm going to do a bit of a deeper dive into the two main SBA loan programs addressed in the CARES Act. And I'm going to start with the Paycheck Protection Program because at least at this time, this is the program that I know we're getting a lot of calls on and there's a lot of uncertainty surrounding. This is a brand new program. It's created out of whole cloth under the CARES Act. It's a short-term program and its purpose will be evident as we go through this. These loans, unlike the disaster loans, are not made directly through the SBA. These loans will be made, at least initially, through third-party banks that are approved by the SBA, and those that are already approved can begin making these loans and processing these loans when everything's sort of up and ready to go, which is not yet. As we move forward, we'll talk a little bit more about that towards the end and when we anticipate these loans will actually start coming through. Now, the SBA can make these loans directly under the statute, but they've indicated they don't really plan on doing that. If not enough banks get on board, they may start doing that, but at least initially, that's not going to happen. So the first step in determining whether anyone qualifies, of course, is determine whether you're an eligible borrower. So the CARES Act, under this program, expands the types of businesses or other organizations, frankly, that may be entitled to participate in the program. So generally, it's an organization that has fewer than 500 employees. If it's a business concern, that can vary a little bit. There are some industries that, pursuant to SBA regulations, are deemed small, even though they have a larger number of employees, and that can be, I think, up to 1,500. So that would be a large, manufacturing company, for example, in certain industries, can have more than 500 employees. So if you are a business or you work for a business and you think that you may be out of the running, it's worth checking out and verifying that. You have to be in operation as of February 15th. You have to have W-2 employees or independent contractors. Now, at the bottom, you'll see that individuals, sole proprietors and independent contractors are eligible as self-employed individuals. So sometimes that last bullet point scares people off, but there is a mechanism for sole proprietors and independent contractors to participate if they otherwise meet the other obligations. As with anything, there are also further exceptions made. The first one relates to accommodation and food services businesses, hotels and restaurants. So these types of businesses have an additional ability to qualify even if they have more than 500 employees, because if they have more than one location and less than 500 per location, they're still deemed to qualify under the statute. The second exception relates to the affiliation rule. And so it also raises an issue that has applicability to clients beyond just explaining this waiver or this applicability of the rule. Because as we've moved forward with this over the last few days, one of the issues that's sort of brought to the fore is this affiliation issue and how it impacts our clients' ability to potentially apply for these loans. So the first thing I'll do is talk a little bit about what that means. As a general proposition, when determining a number of employees, the affiliates of the applicant are combined. So the general basic rule under the SBA regulations is that when a business can control another, or when a third party can control two businesses, then you have affiliation. However, it is far from that simple. It doesn't just refer to majority ownership. It can arise through common management, contractual types of control. It's a totality of the circumstances type test. It can even be negative. So a minority owner who has certain minority protections or has certain board seat rights that are, not in line with the minority ownership, and that in essence create a blocking right, can create an affiliation where none exist, where one normally wouldn't exist if it was simply a minority ownership. So that's an issue that I think everybody needs to keep in mind. It's one that I didn't anticipate would be something I'd be spending a lot of time on, but it has been. So as it relates to the waiver, though, once again, the accommodation and food services businesses are waived from that affiliation rule. Franchise businesses that are affiliated with franchises that have been approved by the SBA. So the SBA has a list, and if you're on that list, or you're a franchisee of the franchisor on that list, then that rule is waived to you. And then any business that receives financial assistance is under 301 of the Small Business Investment Act. What does that mean? That's really it's a sort of, the best way to understand it is like a private equity fund manager that's licensed and receives funds through the government to invest in small businesses. Needless to say, the private equity world generally is hoping to get some relief like that because they have an issue with the affiliation rules if they're not somehow accepted out. So how much money can you get? The overall loan cap is $10 million. Up to that cap, it's 2.5 times your average monthly payroll incurred in the 1 year period before the date of the loan. In addition, if you've received an EID loan, the funds. It's been funded before the PPP loans are available. That is, you can go into the bank and get one. That can be refinanced, so it doesn't impact that 2.5 times amount that you're receiving, unless it sort of bumps up against that $10 million cap. But that's generally the rule of thumb. That's what you're entitled to. So what does payroll mean? Well, payroll costs include the things that you normally think about: salary, benefits, and state, local tax. It also includes wages and tips. It does not include that portion of an employee's salary, which on a prorated basis is more than $100,000. It doesn't include compensation of employees who are not U.S. residents. It also doesn't include federal payroll taxes. So it's 2.5 times, I'm sorry if I was unclear about this, the average monthly payroll costs incurred in the 1 year period. So how can you use these funds? So this act was put together very quickly, and there's a rub, which I talk about at the end there, but generally speaking, the best way to think about these loans is these are loans made to keep the lights on. They're supposed to be used for payroll costs and benefits, salaries, interest on mortgage obligations, rent, utilities, and interest on other outstanding debts. The statute itself provides that the funds can be used for any other purposes allowed under the 7A business loan program. I don't think that was the intent. I don't think that ultimately is going to be allowed. It's not a working capital loan, and I think it's not a very good idea to use it other than for the purposes listed there. Not just because it impacts the amount that can be forgiven, which I'll talk about later. I note there that one of the on the application that has to be signed, you have to agree that you will use the funds for those listed purposes. Although it does say mortgage payments and not interest, it's clearly not meant to be used for inventory or other types of working capital, and I would be hesitant to use it for any other reason. So the general, the loan terms that are listed are what are provided for under the CARES Act. I'm going to talk a little bit towards the end about some of the more, some of the details that have been, at least for now, filled in with respect to some of these terms. So under the CARES Act, the interest rate will not exceed 4%. There are no personal guarantees. There's no collateral. The payment terms aren't really provided for in detail, but what it does provide is that if a balance remains, the maximum maturity is 10 years after the forgiveness request. Just like a lot of the other, maybe all of the other VA loan programs at this point, there's a deferral component to it. And I think the initial deferral is 6 months. My guess is it'll end up being longer than that. The borrower requirements are not very much. There is a certification that must be made that basically you're not cheating. You haven't asked for multiple requests. You're going to use it for the intended purposes and so forth. The loan forgiveness component is probably one of the most attractive parts of this. At the end of the day, if everything goes right, it's not a loan. You can forgive. You can have forgiven all the costs that you've made if you use them for appropriate purposes. And in addition, the CARES Act explicitly provides that the forgiven amounts won't be subject to income tax. So normally, if you have a loan and it's forgiven, that's great, but you realize income tax as a result of the forgiveness. That's not going to happen. So that's just an added benefit to this. The forgivable costs are your payroll costs, just the list that we talked about. Additional wages paid to tipped employees can apply. It's unclear exactly how they're going to figure that out, but that's a big deal for folks trying to keep their restaurant and hospitality clients who are trying to keep their employees around during this time. So there is a downside if you, and we have more details about this on our website, but if you decrease the number of employees that you have, or if the wages paid to your employees go down by more than 25%, then on a proportional basis, the amount that can be forgiven goes down. The exception to this is if you fix a decrease that has occurred by June 30th, 2020. So if you've let people go or furloughed them and you hire them back, or you otherwise get your wages and compensation and numbers of employees back up to where they were, then that's fixed. You've cured the default in essence. So this is where things get a little more complicated, and I think for a lot of clients, they may start rethinking exactly which loan programs they operate under or they seek funds for. So yesterday, the Department of Treasury released some information. And two of those pieces of information was a borrower information sheet and a sample PPP loan application. So one of the items in both the information sheet and the loan application indicates that forgiveness for non-payroll costs, that is, if you remember the list, rent, utilities, so forth, will be limited to 25% of the overall forgiven amount, which in other words means the amount that can be forgiven, 75% of that amount must be payroll costs. And if the costs really are 70-30, that 5% is not going to be subject of the non-payroll costs, won't be subject to forgiveness. That's not in the CARES Act. There's nothing in there that says anything about that. I have no idea where it came from, but it's in the application and it's in that information sheet. I don't think that's the end of that. I know that a lot of people are complaining, and it's hard to see how that rule can just be thrown out there, but that's what it says. The stated interest rate, remember, it can't go above 4%, but word is it's going to be 0.5%. The maturity date, 2 years from the loan date. So this is not in conflict with the CARES Act, but it's much shorter than I think a lot of people anticipated. So especially when you take into account this 75-25 payroll cost to non-payroll cost forgiveness issue, I think that a lot of clients will have to look to see whether or not they need to combine PPP with a disaster loan if their non-payroll costs are higher than that 75-25 materially. 2 years is not a very long time, especially given the situation we're in. And if people aren't expecting to fully get forgiveness for the entire loan, then they need to think about that. So the desire is to start processing the applications April 3rd for businesses and sole proprietorships, and then April 10th for independent contractors and self-employed individuals. There's a little bit more that goes into those two, and I think that's the reason why. The reality is banks aren't sure what they're going to do yet. Banks aren't sure how much they're really going to focus on this program, and this whole thing is in flux and will continue to be, for the next couple of days. But it is a moving target, and our hope is that they do get these up and running at least by next week. So now I'm going to move on to the economic injury disaster loans, which again have not been on the forefront in terms of people's interest, but it may end up being a better deal, at least for the long-term issues that clients may encounter throughout this year. So the economic injury disaster program already exists. It's under the general SBA disaster assistance program, otherwise known as 7B. The CARES Act expands it substantially, and it's expanded through the end of the year, which is longer than the PPP program. It's made directly by the SBA. There are no third-party lenders, and the SBA has streamlined the process. I've talked to some people who have used it, and they say they were amazed that it worked. So for whatever that's worth, it's at least in terms of the application process, I think is more expedient, and it's offered now. You can go on and start the process. Eligibility is similar to what's provided for under the PPP. You have to have been in operation since January 31st. Eligibility is tied to having 500 or fewer employees. They do not have the increased amount for industries that have, just customarily have larger numbers and are still small. It includes nonprofits and individuals that operate as sole proprietors. So this is a known quantity. We already know the interest rate, the 3.75 for businesses, 2.75 for nonprofits. Payments are on a case-by-case basis, but can be up to 30 years. They're typically deemed longer-term loans, unlike the PPP. The deferral is in place now, and personal guarantees are not required for loans of $200,000 or less. So generally speaking, under this loan program, historically it was $25,000, now it's $200,000. If it's more than that, somebody has to guarantee the loan. So if you don't have anybody that owns 20% or more of the equity interest, then somebody has to do it. If for anybody who owns 20% of the equity or more, they have to do it. Now, I believe there are ways the SBA can make exceptions. That's going to be really hard to get right now. In order to do that, you'd have to talk to somebody, and my guess is that is impossible. So I think everyone should just understand that these guarantees are sort of part of the deal. Collateral, the rule is it's generally required if available. They may not apply that rule to loans that don't have to have personal guarantees, but that's not clear. It was not specifically addressed in the CARES Act. I think that was the intent, though, and so they may not be requiring that. The CARES Act lessened what's necessary in order to approve these. It can be based on credit scores or other information. It's all part of the process to try and streamline these and get the money out. Use of funds. So remember, this is a working capital loan. So it can be used to pay fixed debts, payroll, accounts payable, other bills. You can use it to buy things like inventory if it's not sort of outside of the ordinary course of business, not an expansion. So what it's not supposed to be used for are refinancing things, expanding and infrastructure and so forth. So this is one that the emergency advance is a hot topic. We're getting a lot of people calling about these and trying to understand. It's sort of one of those sounds too good to be true things. But generally, it's what people think it is. If you apply for an emergency, one of these disaster loans, the SBA will send you $10,000, and they're supposed to do it within 3 days, or whatever amount you request under that. It does not have to be repaid. It's really a grant, even if the application is denied. Now, if you've lied or you've committed fraud or something like that, I think you have to pay it back, and that may be the least of your concerns at that point. It doesn't need to be paid back, but remember, these types of loans are based on need, and so if you've received the $10,000, then they will take that into account in determining your need. Can I apply just to get the emergency advance? I've heard that a few times. As lawyers, the answer is no. If you don't have the intent to really go through the process, that doesn't mean people don't change their minds. That doesn't mean, any number of things can happen that result in somebody not taking the loan that's offered to them or abandoning the process. But technically, no, you cannot just do that. So with that, I'm going to turn it over to Sarah.
Hi, everyone. So I'm going to cover, just touch on some, and we've gotten several questions too about how some of these apply to nonprofits, and then just a little bit on the healthcare sector as well. On the nonprofit side, the good news is that almost all these benefits are also available to nonprofits, but it's important to note what the terminology is and which kinds of nonprofits. So if your organization is a 501c3, they pretty much all apply to you. But if you have something other than a 501c3, some do and some don't. So I'll walk through those. On the SBA loans, those programs are both open to nonprofits. The PPP is limited, though, to 501c3 organizations and then veterans organizations, which are described in 501c19. On the 501c3 organizations, the Act does not make a distinction between private foundations and public charities, so it doesn't matter what you are within the larger category of 501c3. If you're a 501c3 and you meet the other eligibility requirements, the PPP program loan is available to you. The EIDL loan, the disaster loans, the ones that Andrew was just talking about, the language in the statute is, quote, private nonprofits. The SBA materials that have come out about this extend that to really any nonprofit organization, so not just 501c3s, other kinds of tax exempts, and even organizations that are organized under as nonprofits under state law that maybe are not tax exempt. So a little bit broader application for the nonprofit community. If you don't take either one of these loans, Darren mentioned this at the very beginning, there is a different program available for the employee retention payroll tax credits, and those are also available to all tax-exempt organizations. They're mutually exclusive with the SBA loan. So if you do either of the SBA loan programs, you wouldn't be eligible for that payroll tax credit. But if you are not eligible for the SBA loans or you choose not to take them, there's a tax credit that provides some financial assistance, and that's on payroll taxes. So it is a tax that, that tax exempts pay, notwithstanding the terminology. The other one to mention is unemployment benefits. Now this would apply to obviously your employees if they're laid off, furloughed, or have a reduction in hours. But there's an important thing for nonprofits to pay attention to. So if you're nonprofits have the option of paying into the unemployment system the same as every other business and pay unemployment insurance tax. If that's the approach that you have taken in your organization, how this will affect you will depend on how your state has handled these rules. In Minnesota, the governor's executive order on extending unemployment and then the legislative action more recently codified this, is going to hold, supposed to hold employers harmless for a rate increase in their tax rate based on their employees using these extended benefits. But that's a state-by-state framework. And so if you're not in Minnesota, you'll need to understand how that's going to affect you, you'll have to look at your own state's rules. Many nonprofits in general are also eligible, though, to opt out of that pay-as-you-go system or pay into the system by tax, and instead are what's called reimbursing employers, which means they don't pay prospectively, and then if employees claim uninsurance benefits, the nonprofit has to pay 100% of those benefits that get paid. The CARES Act provides federal assistance on that up to 50% of the costs of the unemployment benefits for those reimbursing employers. I believe, and I'm not a deep expert in how the unemployment system works, I think that there's still state action that's needed to actually implement that relief, and then a policy choice that states can make to fill in the other half, the other 50%. So if you're looking at potential layoffs, hour reductions, or furloughs, recognizing your employees will be eligible for more benefits, it will also be important to take into account what that's going to cost you so that you can be planning accordingly. Darren mentioned this too, the economic stimulus loans. These are the economic stabilization for severely distressed sectors, the Federal Reserve funding. Those are also available to nonprofits, so it's not limited to for-profit businesses. And as was mentioned earlier, those are not forgivable, but they're low interest loans and have more favorable terms. It's not currently clear. It's clearly the case that 501c3 organizations are eligible for those. For other kinds of tax exempts like C4s, 5s, and 6s, which would be social welfare, labor unions, and trade associations, it's not entirely clear yet, but hopefully some guidance will be forthcoming on that. The last thing I want to mention about nonprofits is on the positive side, in terms of just helping raise donor dollars, there was also some increased incentives for charitable giving. So the first one applies to all taxpayers, so these are individual donors. There's a new universal charitable deduction. So normally when an individual makes a charitable contribution, the benefit of the deductibility really practically only kicks in if the person itemizes. And with the increase in the standard deduction, fewer taxpayers are itemizing on their taxes. A universal charitable deduction is now in effect, and it does not currently have an expiration date. For $300, is deductible whether you itemize or not. So for all of us as donors, we can take that deduction for $300, and it's something that charities can use to help encourage people to continue to support them through this time. The other change that was made that's an incentive, this one is time limited just for the calendar year 2020, which is for major donors. Normally there is a limit of how much your adjusted gross income you can take as a charitable deduction, and there's some variations on it, but for a cash gift to a public charity, normally a person can only deduct up to 60% of their adjusted gross income. That number was raised to 100% in 2020. So if you have donors who are major donors who bump into that adjusted gross income limitation, it's not applicable to them this year. And in particular, in a year where their adjusted gross income is likely to be lower, that's going to be could be potentially really helpful. There's a similar limitation for corporations. They normally can only deduct 10% of their, what's the equivalent of their adjusted gross income, and that number was increased to 25%. So more tax incentive for charitable giving in this year. The other thing I just want to mention is, and Darren touched on this with respect to agriculture, there's also a bunch of funding in the CARES Act that is getting pushed out to various federal agencies, some of which is for the purpose then of making grants within their areas of focus. And there's a whole lot of them, but these four were the ones that particularly caught my eye that are likely to be relevant to many nonprofits. So the National Endowment for the Arts and National Endowment for the Humanities, the National Science Foundation, and Legal Services Corporation, which funds all the legal aid organizations. But all of those, the funding that went to them clearly contemplated that they in turn would be making that funding available to their constituencies in the form of grants. So if you fit into any of these service areas, it's definitely worth paying attention to what these agencies are doing and what funding opportunities come through them. I'm going to turn now to healthcare providers, and just a quick overview. So one just important thing to mention for those of you who are not in healthcare that I just think is helpful to be aware of in the world. The healthcare sector is experiencing a real kind of set of extremes of how the public health emergency is affecting healthcare. On the one hand, you have what we have all been hearing about in the news, the frontline healthcare system that is treating and caring for and diagnosing patients with the coronavirus and the related impacts of that. That part of the healthcare system is overwhelmed. You have the other part of the healthcare system, which are all those elective surgeries that got canceled in Minnesota and many other states, or just routine healthcare that people are not accessing because they're being told to stay at home and shelter in place, where those businesses and organizations are experiencing the same kinds of economic hardship and impact that the restaurant and hospitality and airline industries are experiencing. So it's a real kind of story of extremes. The funding of the Public Health and Social Services Emergency Fund that Darren mentioned at the beginning is, significant funding that is going out to the healthcare system. It is really focused on that frontline part of the equation. So organizations that are involved in any way around diagnosing and treating patients with the coronavirus. It's less about the rest of the healthcare system and maintaining that in place. There are then likewise a whole bunch of other ways that the CARES Act addresses funding to help make sure that the healthcare system is able to take care of patients and not held back by all the arcane rules that apply in the healthcare context. So the CARES Act specifically addressed a number of funding mechanisms, including additional funding for treating patients with COVID-19, lifting some cuts that were coming, increasing some cuts that were or undoing some cuts both in Medicare and Medicaid, allowing sort of prepayment of Medicare payments to hospitals. This flexibility to move patients to different settings is really important. The Medicare rules in particular are very limited. If you're in getting paid to be in a hospital, you have to actually be in a hospital, and these rules open up that there may be the ability to pay hospital charges if the person is in a stadium or a hotel, if it's necessary for this public health emergency. So a bunch of policy provisions in the bill to address the supply chain, both in terms of medications and personal protective equipment, and to address the shortfall in testing. And then a really big policy impact that helps not just patients with the coronavirus, but actually all patients is significant expansion of telehealth and the payment rules that applicable to that. And many of you maybe have started seeing ads for that with mental health care and primary care, much more ability to provide health care remotely. It'll be interesting to see if that carries beyond this public health crisis. So that's it for a very speedy summary of what's going on with the healthcare sector, and I am going to hand it over to Jeff.
Well, good morning to some, good afternoon to others. I am calling from my basement office, so I'm glad that everyone is available to join us this today. So the purpose of my conversation, my presentation is really the PPP, or the Paycheck Protection Program, that process. And this material was done late yesterday, and it's quickly becoming out of date because it's moving quickly. Andrew touched on a couple things that are new information to us in the last 12 hours regarding the timing. Specifically, this Friday is the application period opens. That application has actually physically been drafted, and there are some informational sheets out there that will be eventually part of our website, and you can now get from the U.S. Treasury Office, their website, that both informational sheets and the actual application. We are also having a good conversation on the chat room, so feel free to use that as well. What I'm going to be talking about is that process, and I am a bank lawyer, so I come from this from a little bit of a different perspective as to what banks potentially are thinking. And the questions are always, what are the underwriting standards? And what we're learning too is, although the SBA has the ability to loan directly, at least initially, they're pushing this out to banks. And so what at least the SBA is thinking now is that these are going to be bank loans that the SBA is going to guarantee. And that's a that comes with its own concerns, and really what's the economic benefit of a bank making these loans? Is there enough of an economic incentive or carrot for the bank to make the loans? And so again, these loans are at a half percent interest for 2 years. It's not clear what those payments are, although we know that there's a 6-month deferral of payment. So presumably there are payments from month 6 to month 18, or I'm sorry, month 24. We don't know what that is. But again, this is a bank loan and it's a below market rate. And the question is always, is there a marketplace for this? And then 2, there is some compensation to the lender based on the size of the loan. That would be an upfront fee that would be charged. So again, this is evolving, but we are learning more that at least starting on this Friday, the application process, applications can be submitted. And the lender, and at least initially, it's an SBA preferred lender or approved lender, and then it is opened up to other financial institutions that can and will be approved through the process. But those will be limited to that. On the action items, it's important that we stay informed. It's also important that we stay engaged. And finally, to be realistic. I think that there's going to be a backlog here, right? The scope of this is large. A lot of businesses qualify. There's a significant need, and we don't have the infrastructure through the SBA process to accommodate that. And so we need to be realistic as to how quickly this money will actually be forthcoming, and what's available. And so that's an important thing that we just need to keep our eye on. And finally, it's important to be strategic in what we're doing. We need to understand the opportunities. The scope, the breadth of the statute. There's conversations about a June 30th and what that means as to the debt forgiveness portion of this, and some additional federal legislation that Darren mentioned, and how you can be strategic with some of these things, and using professionals to help you advise you on that. Finally, there's risks associated with any government program, and to the extent there's a repayment portion, that not all the debt is forgiven, some is repaid. What does that look like? And finally, in addition, maximizing state programs, and then finally, taking into consideration what your existing credit facilities look like and whether or not these additional funds are allowed or permitted under your existing credit facilities with your existing lenders. With that, our time is getting away from us, so I just want to focus again on this is an ever-changing environment. We are planning to have a follow-up webinar to address some of these concerns as the dust settles, but with ever-moving regulations and what this will look like, it's important that you surround yourself with the professionals. And so we are going to schedule another webinar and to give some additional information. With that, I'm going to open this up to the presentation group to see if there's some other things that the group wants to address.
So this is Darren Macbeth. It's 12:55, and we're doing our best to monitor many good questions that are coming in the chat box that we just don't have time to get into all of them. I will try to aggregate 1 or 2 of them in the few minutes we have left before 1 o'clock to try to respond to, and it's probably for Andrew and Jeff. There's been a number of questions about kind of the interplay between an EIDL or a disaster loan and a PPP, including, can one apply for both? Is there concern about the timing of applying for one and then waiting for getting the other? And then also, if one wants to get both, what is the interplay or the overlap between using them? For what purposes? And so, Andrew, I know we've talked about that. Do you want to answer that quickly?
Yeah, And that's a very good question, and one that's the answer to that question's, I think, changed over time. I think initially the idea really was that everyone would sort of wait until the PPP process got up and running before looking at the EIDL process. That's changed a little bit, and you know, if you look at, if you think about what some of us have said here on the call, we're not even sure to what extent these PPP loans are going to be available to those who do not already have an existing banking relationship with an SBA lender. My own thought is that it's going to happen, that, you know, if the SBA sees that the banks are not making the loans because they're not attractive, then the SBA will act in some way. And that may be taking some of this in-house and making the loans directly, but clients don't have that long. So what do we do now? The answer is you're allowed to get to apply for both. And the issue becomes, what happens if you get funded for both? And what you have to make sure is that you're not taking and keeping money in a duplicative manner for the same costs. Okay, so when you apply for the EIDL, you're gonna have to say why you need the money. And for the PPP loan, there's a small category of things. So you just have to be careful about not taking money and you being deemed to have taken money twice for the same reason. And I think if you're careful, I think that's probably an easy thing to do. And that would be the one thing you need to look at. In addition, you know, some of the clients and some of the folks that I talk to who are professionals who are looking at this have discussed setting up separate accounts to hold certainly the PPP funds to better track things and in part to make sure that the money's going in the right place and that you can show that, and also to make sure you maximize the forgiveness factor. So on top of that, the 75-25 issue that Darren brought up and I discussed is a big deal for a lot of clients who just have a higher number of these costs that they need to pay in order to keep the lights on. And so that may shift people who are looking at really just focusing on the PPP loans to doing a combination. And so I think really you're going to see a lot more of that. And, you know, the banks and the SBA are going to, you know, they're not going to be looking at it with a suspicious eye because it's going to be a lot more common. So that's not a great answer to what's going on, but there really aren't that many. But if it were me now, and this is not what I would have said a few days ago, I would start looking at that EIDL loan application and thinking about whether or not you should go ahead and do it.
Thank you, Andrew. There's one final question that I'll ask our co-panelists to address, and that is having to do with when determining the average month for the PPP loan, when determining the average monthly payroll that one takes times 2.5, what all can go into that definition of payroll costs, particularly healthcare benefits or healthcare premiums and 1099 costs? Jeff or Andrew?
So I don't, at least for now, and this is not the spirit of the act and the rule about payroll costs, but right now the answer is I don't see anything that would allow the inclusion of 1099 costs. You know, again, I think that's now beyond that, it includes the payment of state and local payroll taxes, but not federal. Payment of group health benefits, including the insurance premiums, paid leave, and there's I'm not sure how to deal with this, and maybe the accountants will be better served answering this, or those who actually have maybe there's a way of doing this. I'm just not aware of it. But with respect to businesses that have employees that rely on tips, you can include what I assume to be a presumed tip amount as part of your payroll costs. I mean, the overall idea is it's really about the employees. You see that throughout this entire act, including the 75-25 rule that we talked about, is that that's the key. And that's why hopefully there'll be clarity on the 1099. But right now, the way I read it, the way other people have read it, it just doesn't reference anything other than employees, which in that portion, which has employees has a distinct legal meaning.
Well, unfortunately, that's going to have to bring our webinar to a close. Several questions were asked about the availability of these slides. They will be made available to our participants on this webinar in a follow-up email. We'll also have them on our website. And the webinar has been recorded, the dialogue, which will also be made available. So we appreciate everybody participating and apologize we couldn't answer more questions. We know there are many, many of them that are still being resolved. And feel free to follow up with any of us at Lathrop GPM or your other professional providers. Thank you.